Hey everybody, welcome back to STR Unfiltered. I'm here with my good friend and super team member, Mr. Ryan Bakke. Ryan Bakke, how are you today?
I'm awesome, and we're here in Smith Lake at your nice place. Two nice places here. Just finishing up a mastermind meeting. It's been great. Good 3-4 days of education. So
And you just had sushi at the station for dinner. How was it?
I haven't had to go to the bathroom yet, so we'll see what happens.
Honestly, did you like it?
I loved it. I liked
It was
sushi.
pretty good for a fucking gas station.
I tempered my expectations, but it worked out.
Nice. If you've ever eaten sushi at a gas station, I want you to comment yes down below because I don't think very many people have had sushi at a gas station.
Nope.
So we're just wrapping up. You did not really a tax session yesterday, but you did more of a retirement planning session. And you had 4 things that you said everybody should do. Can you kind of just run through those briefly for everybody?
Yeah, I think each investor, the first step should have an emergency fund for all their properties as well as their life.
Mhm.
So whatever their monthly spend is in terms of personal expenses, you want to have 3 to 6 months of those saved up in a
Which one?
high yield saving. 3 to 6 months.
But which one? Which are you recommending, or how do you determine? If I'm brand new and I don't have that,
Yeah.
I know I want to get to 3 months first, but what's the difference between 3 and 6 in your opinion?
Well, 6 months emergency fund is going to be for somebody who has a job that's you're not going to be able to replace it easy enough.
Mm-hmm.
So it might be a very niche career field or a position where you might be high up at that company and it's not likely you'd get a job somewhere else making the same money.
Right.
You're going to want to have a higher emergency fund. Even if you're going into slow season on your properties, it might be a good idea to beef up that closer to 6 months.
So 6 months for like personal expenses.
Yeah.
Right. So if I make $10,000 a month, I need $60,000 in a cash reserve.
If you spend $10,000 a month. Yeah.
Right. Well, that's what I meant. Sorry. My
Yeah.
household expense is $10,000 a month. So should that be in a checking account? Do you put it in a money marketing account? Try to make 4 or 5%?
Yeah. I would start just in a high yield savings or a money market account. It's not there to make you wealthy. It's there to protect you if something bad were to happen. If a
That's
roof
awesome.
goes out, insurance, you have a fire, part of your building burns down. Like, it's not there to make you wealthy. It's there to make sure that you sleep well at night.
And then you said the same for your business.
That's right.
So what if somebody owns a plumbing company that, costs them $10,000 a month with payroll and everything to run their company, and then they have 2 short-term rentals that are about $10,000 a month? Does that mean they need $10,000 for their short-term rentals? Really, $60,000 and $60,000? Is that your recommendation?
It's going to be dependent on the business also too, but a plumbing company, depending on the margins, if they only have 10-15% margins per month, 20% margins, they're going to want to have a higher
That's thin.
Yeah, it's very thin. So you're going to want to have a higher cash on hand to weather storms.
What about somebody like me that has multiple and big short-term rentals, right? And I just took on $3.3 million in debt on one property. Is it still that standard 6 months, or can it be a larger number than a portfolio reserve?
And I think it depends on your overall net worth and how much of it you have in real estate versus not real estate. One of the most common mistakes a lot of people make is they go all in on real estate.
Mhm.
So we onboard about 20 to 25 new clients a month. The first thing we do is get them to fill out a net worth statement. It shows their properties, both primary and their rentals, how do they own it, whether it's in LLCs or not, but it also shows the breakout between their real estate equity and then their 401ks,
Right.
IRAs. And the average investor we're bringing on's got $1 million, $1.5 million, $2 million net worth.
But they're all in real estate.
If we told them to take out 20 grand on Friday, they couldn't do it.
That's scary.
And I think every investor should have between 8 to 12% of their net worth in cash or taxable brokerage account.
I agree. So my monthly nut is right around $60,000 a month for operating costs, and I keep right about $1 million to cover the entire portfolio because I'm pretty conservative. I don't think many people would be, and that's not the investing side of it. That's just for the portfolio.
Right.
But I think as you get your equity position greater and greater and that basis increases, do you believe that you can kind of peel that back a little bit?
I think so. Yeah, I think once you're at a higher level, you can afford to have less percent cash on hand. But for, let's say, a sub $3 million investor, I think you should, if you have less than a $3 million net worth, then you should have 150, 200 grand on hand at any time.
There are a lot, I think, more than probably that have that do not have access to cash.
Right.
It's kind of a scary thing.
And it doesn't have to be cash sitting in a mattress or something. It's cash, whether it's in a high yield savings. We talked a little bit about a taxable brokerage account. So maybe it's an index fund that's tracking the federal government. It earns 4.5 to 4.8% a year, and it's safe.
Could be an ETF or something.
Yeah, and the point of it again is not to get you rich, but it's to prevent something bad from happening. You got to play offense and defense at the same time.
Agreed. What's the next one?
So the next step after that is I still believe for those that are employed still, they should take advantage of the 401k match because it is free money at the end of the day.
Right.
Whatever percent they match, whether it's 4 or 5%. So contribute up to the employer match because it's free money. But then it kind of plays into this thing that I call the financial independence number. And the financial independence number represents how much money you need to invest per month just to be comfortable with retirement. And comfortable with retirement means a little bit different for everybody, but let's say my number is $500 a month. So if I invest $500 a month into 401ks or IRAs, I'm going to have $3.5 million by the time I retire. So that's my
starting at your age,
right,
which is 26.
Right.
Starting at you start at my age at 51.
It's going to be $1,500 a month,
right?
$2,000 a month, right? To get to where you want to be at retirement. But once you achieve that FI number, so let's say my number is $500 a month that I have to invest. Well, this month I just made $1,700 or $2,000. Every dollar after that FI number goes towards buying my freedom quicker.
Right.
Real estate, other businesses, just to get that financial freedom quicker. But worst case scenario, all my real estate goes to burns. If I lose everything, I'll still have that financial independence.
I mean, you know about my life plan. Obviously, you've been through that a gazillion times, but people struggle to think about, even at my age, I'm 51. I want to retire at 60, whatever that number is. They don't know how much money they need at that standpoint. You're 26. How do you figure that out? How do you know what you want in retirement today and you're not going to retire for 10, 15, 20, 25 years?
Yeah, in finance, they have a thing they call discounted cash flows. So you have an income stream. Well, a $100,000 income stream a year now is not the same as a $100,000 income stream in 20 years, right? You probably need a $150,000 income stream then. So you're able to, by using smart calculators, and maybe it is hiring a financial advisor, but you're able to project out, okay, if I do want to live on the equivalent of $200,000 in 2045 money, I need to have this nest egg here.
Right. I think people just pick an arbitrary numbers. I need $1 million or I need $2 million. Would you agree with that?
Yeah, and they're saying right now, Fidelity is saying that the average American couple from age 55 to when they pass away is going to spend over $300,000 just in medical expenses.
I can see it.
And the average 401k balance right now is half of that.
Really?
Yeah.
That's crazy. All right, are we on to the fourth one now?
The fourth one is once you invest that financial independence number, that's when you start buying real estate. Right?
Wow, so you got to do the first three first before.
I think so.
Gotcha.
Yeah.
And does that depend on your current income or current wealth? Is there a variation, or that is standard for everybody?
Yeah, well, your current income, once your income does go up, you're going to be able to check boxes 1, 2, and 3 a lot quicker.
Mm-hmm.
But those are the baby. I mean, those are the equivalent to the Ramsey baby steps.
Right.
So they're the baby steps for a reason. Because if you do them not in order, you can mess it up.
Agreed.
Right?
That's awesome stuff. I want to flip the script here for a second, just talk about something different. You let me know about something. You're actually filing tax returns now.
Yeah.
And that is something since you started.
Tax return only.
You started doing this when when I met you, I guess it's been just over three years now. You didn't want to get into tax returns. You're really just doing consulting and that type of stuff. So I know you've launched a new, more affordable program. Tell me about that.
Yeah, so the goal is to get every real estate investor can get affordable, good tax prep by real estate CPAs that know what they're doing. We're actually here in Smith Lake, and I had somebody message me, the lender that we know, and they said, oh, my CPA won't sign off on this, or they won't represent the financials a certain way, and we want to have our clients be able to close on loans. So this loan's getting closed on Friday, and they just got confirmation today that they're able to close because their CPA was taking forever to respond. And so we want to have affordable tax prep, and everybody can get good tax advice within this community. So they'll get access to the templates, courses, trainings, anything that I've ever done before. And they'll also get a monthly call, a group call. We'll have different topics each week, but every single person part of that community will also get their tax return file.
So tax returns filed, access to a community of like-minded investors, individuals, and monthly coaching.
That's right.
How much is it?
$3,000 minimum.
That's it?
That's it. Now it's going to depend how big their portfolio is.
Right.
So somebody who's got 10, 15 properties, they're going to pay more than the minimum.
Right.
But the average person that's got 1, 2, up to 5 properties, it's going to be $3,000 to $4,000 for them.
That sounds like a pretty good deal to me.
Yeah. And there's so much money that a lot of investors miss. Our average client that we review their tax returns, we're finding $8,000 in errors on previous returns.
Really?
That could be missed deductions. They just miss insurance, utilities, mortgage interest, missed write-offs. They had assets that they didn't bonus depreciate in the past. Average client, $8,000 in errors just on missed returns.
So what do you do when you find that? Then you go back and you file for them and just go and do a change of accounting?
Depending on, so for expenses, you can't do a change of accounting if it's a...
Just amend it?
Yeah, you have to amend it.
Gotcha.
So you might have somebody that, okay, well, they had $20,000 in missed expenses. Well, if they're in a 37% tax bracket, that's almost $8,000 in missed tax savings.
Right.
So we'll charge them $3,000 to amend their return, and now they get $5,000 in their pocket.
That sounds like a good deal.
That they wouldn't have otherwise had. Or, I mean, the quickest and easiest way is always for them to go to their accountant or CPA and have them amend it.
Right.
But sometimes they fall out of communication, or once the accountant hears that they're working with somebody else, they don't want to talk to them anymore.
So your new $3,000 program, that's the minimum. It could go up for somebody like me. When does that start, or is it already available?
That's a great question. So this is going to be for 2024 tax returns moving forward.
Mm-hmm.
So these are going to be for returns that are filed in April of 2025.
So now's the time to get in.
Now's the time to get in.
Because on your coaching calls, you're probably going to be helping them with tax planning through the end of the year, right?
Yeah, and whether or not they sign up now or they sign up in February, it's still the same price. So they might as well get access to all that information now, so they can actually use it to save
honestly,
money.
it probably shouldn't be the same price in February. You're probably going to have to raise the price.
Who knows what happens? One of the big reasons why I haven't done it yet is just the staffing issues.
Right.
I mean, it's really hard to get good talent, good CPAs that know what they're doing, especially in real estate.
Right.
And so that's why we're going to cap it at a certain amount of clients, take on 100 clients before we take on more clients, because we need to hire more CPAs.
Right. Here's what I'm going to tell you folks out there. I mean, Ryan has saved me millions, literally millions of dollars, and I'm grateful for you for helping me for that and consulting with me, and, kind of a, give and take with you being in the mastermind and that type of stuff. One thing I will tell you, at $3,000, it's affordable even for the person that just owns one property. And you need to make sure, whether it's Ryan or somebody else, and believe me, I know Hall CPAs, I know David Perez, I know Anderson, I know all of them, and this is the guy that I choose. So if you want to get in on that, Ryan's been gracious enough. I'm going to give you a link right down here in the show notes, whether you're listening to the podcast on Amazon or Spotify or whatever, or watching on YouTube. And if you are on YouTube and you have some questions, just jump down and tag Ryan or myself, and you can find Ryan everywhere: TikTok, Facebook, Instagram, at Learn Like a CPA.
That's
correct?
Right. Yep.
Awesome. Thanks for staying late and doing this with me, and I really appreciate it.
Thank you. Thanks, everyone.
Happy hosting, everybody.